Hi, I am Professor Sesha Radha. Introduction to Economics of Competition Law, Part 1. The module tries to explain the concepts essential to understand the behavior of firm as a business unit, satisfying the producer's interest of profit maximization and consumers' utility maximization, emphasizing on the basics of demand and supply, elasticity of demand and supply, cost concepts, and the concept of social welfare. The key objective, therefore, is to give a good foundation for understanding the economics of competition law and policy. Economic benefits of competition law. Competition in the market benefits all the participants. Consumers. The competition enables the consumer surplus to the consumers, profit maximization to the producer or seller, and revenue to the state, leading to the overall growth and stability of the economy. The benefit of competition provide goods to consumers at competitive prices. It also provides them with new and innovative products. The demand then gets diversified and the consumer satisfaction is enhanced with multiple varieties of products available in the market. The lifestyle of the people gets changed and moved towards higher levels of satisfaction. Producers. The producer is also the consumer of raw material and energy resources, telecommunication services, the computer technology, infrastructure requirements for manufacturing and storing. Competition also has a positive impact on efficiency and productivity in the pursuit of getting competitive advantage. Innovation is possible with technology based production. High standard is aimed at in the quality of products while enjoying the benefits of economies of scale. To the economy, competition fosters restructuring of the sectors of the economy, influencing market demand, product uses, costs, technologies and the like. The demand for capital for enhanced business activity forces the generation of capital requirements and thus the interlinking of the various economic activities in the country from production to distribution and to final consumption. In short, the microeconomic behavior of producer surplus and consumer surplus ultimately end in the creation and sustenance of aggregate demand and aggregate supply essential for growth with stability of the economy. Concepts of demand and supply. Demand and supply are the two pillars of market and all the theorizing of economics are built up on them, from microeconomic analysis of simple demand and supply to the Keynesian aggregate demand and aggregate supply. Economic theorizing has enlightened the audience of the discipline of economics. Demand. Wants are turned into demand at a price. Demand is dependent upon taste and ability to buy. Taste determines the willingness to buy a good at a specific price. Ability to buy is determined by money at hand. Demand is generally at a price and popularly understood as the price elasticity of demand. The following diagram shows the downward sloping demand curve with reference to the relationship between price and the quantity demanded. It is presumed that all the other factors such as taste of the consumer, income of the consumer, availability of substitutes, price of substitutes and the like remain constant when only the price and the quantity demanded are compared. Now, this demand curve generally have a negative slope. Demand curve slope downwards due to the law of diminishing marginal utility, the income effect and the substitution effect. Demand is determined by income, price of substitutes, prices of complements, advertising, population, consumer expectations. The demand function quantity demanded is of or is the function of QXD is equal to the function of Px, Py, M, H. Quantity demanded of good X, price of X, Py is the price of substitute good Y, M is the income and H is any other variable affecting the demand. Consumer surplus. Consumer surplus is defined as the difference between what the consumer is willing to pay and what he actually pays instead of going without the good he wants to buy. This is the measure of surplus satisfaction and Marshall calls it as a consumer surplus. The summation of the consumer surplus is the total consumer welfare in the society. Consumer surplus thus measures the difference between the ability to pay and the willingness to pay of the people, a foundation on which the welfare analysis of consumer behavior is built. In the diagram, the portion above the equilibrium price represents the consumer surplus as given in the shaded area. In the general economic analysis, supply is at a price and directly proportional to the increase in price. Since profit making and profit maximization are the basic goals of production, supply price increase is an incentive to produce more and supply. The supply curve slopes upward, reflecting the higher price needed to cover the higher marginal cost of production. The higher marginal cost arises because of the diminishing returns to the variable factors. Now, supply curve is shown in this diagram with an upward sloping supply curve. Factors determining the supply are input prices, technology or government regulations, number of firms, substitutes in production, taxes, producer expectations. The supply function is given as the equation representing the supply curve. Qx supply is a function of Px, Pr, W, H. Qxs is the quantity supply of good X, Px is the price of good X, Pr is the price of a related good, W is the price of inputs, for example the wages, and H is the other variable affecting the supply. Producer surplus is the amount the producers receive in excess of the amount necessary to induce them to produce a good. The market equilibrium is given as the balancing of the supply and demand, where Qxs is equal to Qxd. Price restrictions, price ceilings, the maximum legal price that can be charged. Price floors is the minimum legal price that can be charged, for example the minimum wage, the agregal price supports and the like. Now, elasticity of demand. The law of demand states that the quantity demanded increases with the price fall. The responsiveness or sensitivity of the quantity demanded to a change in price is measured by the price elasticity of demand. The price elasticity of demand is defined as a ratio of the percentage change in the quantity demanded of a product or resource to the percentage change in price. ED is equal to percentage change in quantity demanded of product X to percentage change in price of product X. We use percentage change rather than the absolute change because the choice of units can mislead us, or by using percentages we can compare consumer responsiveness to changes in prices of different products. Degree of elasticity. Elastic demand for a product is elastic if its price elasticity is greater than 1. Inelastic demand, that is the demand for a product is inelastic if its price elasticity is less than 1. Unit elasticity is the elasticity coefficient of demand or supply is equal to 1. Perfectly inelastic demand, that is the quantity demanded does not respond to change in price. Perfectly elastic demand is the quantity demanded will go from 0 to infinity at a particular product price. Determinants of price elasticity of demand are substitutability, luxury versus necessity, proportion of income and the time involved. Price elasticity of supply, the ratio of the percentage change in quantity supplied of a product to the percentage change in its price, the responsiveness of production to a change in price of a product or resource. ES is equal to percentage change in the quantity supplied of product to the percentage change in price of product X. We can consider firm's supply elasticity according to the time period, namely market period, short run and the long run. Cross elasticity of demand measures how sensitive the consumer demand for one product to the change in the price of the related substitute. The ratio of the percentage change in quantity demanded of a product to the percentage change in the price of the substitute. EXY is equal to percentage change in quantity demanded of product X to the percentage in the price of product Y. Positive coefficient indicates that the two goods are substitutes. A negative coefficient indicates that the goods are complements. A 0 or near 0 coefficients indicate that the two goods are independent. Income elasticity of demand. Income elasticity of demand is the degree to which the consumer demand responds to change in income. The ratio of the percentage change in the quantity demanded of a good to a percentage change in the consumer income is the income elasticity of demand. EI is equal to percentage change in the quantity demanded of a product to the percentage change in income. A positive coefficient indicates that the good is a normal good. A negative coefficient indicates that the good is an informal good. Demand side substitution takes place when consumers switch from one product to another in response to a change in the relative prices of the products of different firms. If consumers are in a position to switch to available substitute products or to begin sourcing their requirements from suppliers located in other areas, then it is unlikely that the price increase will be profitable. This depends on the elasticity of demand for the product in question and all the other determinants of demand mentioned earlier. It is important in the study of monopoly pricing, market power and market share in the relevant product market and geographic market under the competition policy and law. Supply side substitution. Producers may also be able to supply a given product to satisfy the demand for product switching. The monopoly power or share is reduced to that extent of supply side substitution. But the ability and the incentive of the competing firms to supply such products depend upon their expected substantial profitability and duration of sustenance. The sunk costs and the capacity of the firm for immediate entry are some of the important considerations to go for supply side substitution. Cost concepts and functions. Cost of production is defined as the aggregate of price paid to the factors used in the production of a commodity. Cost concepts are used for accounting purposes and also for analytical purposes such as the economic analysis. Business cost is defined as the actual or real cost, namely all payments and contractual obligations made by the firm and is used for calculating business profits. Opportunity cost is the extra cost incurred to prevent a particular resource or input to go over to the next best alternative use, or defined as the income foregone remaining in the current use. Economic costs include the cost of making a product as well as the opportunity cost. Economic costs include the costs of producing a product as well as the opportunities foregone by producing the given product. Explicit and implicit costs. Explicit is the actual money expenses recorded in the books of accounts. Cost not appearing in the accounting system is implicit cost. Example, the opportunity cost. Explicit plus implicit cost is equal to economic cost. Cost concepts and functions. Cost of production is defined as the aggregate of price paid to the factors used in the production of a commodity. Actual costs refer to real transactions. Discretionary costs are not strictly necessary for current production but correspond to strategic goals of the firm. Attributed costs are the computed values from accountancy that are conventionally attributed to products as part of the process trying to establish profitable prices by routine. Production costs are usually classified according to the responsiveness to different levels of production attained in a product from material to matter. The time period is taken into account when considering the fixed cost and variable cost. The short term or the long term may be defined depending on the nature of the product under study. For perishable goods, even 1 hour may be taken as a short period and the long run may be taken as a day. Fixed costs are defined with reference to the time period. In the short run, the factors of production or inputs cannot be varied and they are also sunk costs. The cost remain the same independent of the quantity produced or supplied. Variable costs imply that all costs are variable in the long run. The firm has the capacity to expand its infrastructure, machinery, capital and the like in the long period. The variable costs increase with higher levels of production. Total costs show an upward sloping curve, which means the cost grow up with the increased production. Short run costs are explained under different headings. The total cost consists of total fixed cost and total variable cost. Total fixed cost is the total fixed cost of all the inputs which are fixed in the short run. Total variable cost is the total variable cost of all the inputs which are variable in the long run. Note that all inputs are fixed in the short run and all inputs are variable in the long run. Inputs can be adjusted or contracted or expanded in the long run. AFC is the average fixed cost and it is the cost of all the fixed inputs per unit of output. AFC is equal to TFC divided by Q. ABC is the average variable cost and it is the cost of all variable inputs per unit of output, that is ABC is equal to TVC divided by Q. Average cost enables the measurement of the profitability. If the price is higher than the average cost, higher is the profit in a given unit of production. Marginal cost or MC is the change in the total cost to the change in quantity. Marginal cost indicate by how much the total cost changes because of the addition to the production level by one more unit. When there are only fixed costs, marginal cost will be 0. Any increase in production does not change cost. Long run cost or the long run total cost LRTC is the cost of all inputs in the long run using the least cost method of producing any given output level. Long run average cost LRATC is the cost per unit in the long run using the least cost method of producing a given level of output. LRATC is equal to LRTC divided by Q. Investment cost. Investment cost is the definition of which is an asset or an input purchased with the expectation that it will generate income or it will appreciate in its value in future. In finance, an investment is a monetary asset purchased that the asset will provide income in the future or appreciate and be sold at a higher price. Incremental cost. Incremental or marginal costs come from changes in a given activity. Manufacturing more parts or changing the hours of service or business open would cause incremental costs to accrue. Variable costs are incremental because they vary with the activity. If employees are paid hourly and work for more hours, labor costs will increase incrementally. Sunk cost. Sunk cost, also known as fixed cost, or the cost already incurred. For example, if a hospital installs a sophisticated medical equipment, whether there are people trained to use it or not, or the patients are required for the treatment with that equipment or not, the money spent or rent payable, they remain the same. Money spent on R&D are also sunk costs if the outcome is successful or not, or usable or not. Sunk costs represent barriers to entry and exit. A firm which has incurred high sunk costs will have difficulties in deciding to exit the market even if it sees good opportunities outside. Conversely, a firm deciding to enter into a certain business has to consider with a particular attention the sunk costs. The sunk costs in this perspective represent barriers to entry or exit. Concept of a firm. A firm is a unit of an industry. Marshall calls it a representative firm. That is, a firm represents the characteristics of a given industry. In general, every firm is a profit maximizing firm in pursuit of remaining in the business. It tries to keep the average cost at the minimum for a higher margin of profit. However, the profit making prospects of a firm is dependent on the competitive conditions in which it works. For example, in the imperfect competition, due to the enormous number of firms operating in the industry, the competition is a cutthroat one and therefore the margin of profit is also limited. In the case of monopoly, the firm may reap a high level of profit due to the monopoly market power. The firm's existence is subordinated either to the shareholders or to the stakeholders. The shareholder theory envisages value maximization as a primary objective, that is, maximization of firm's equity, the present value of expected benefits that the shareholders can expect from the firm. According to this definition, a firm's value can be maximized only when the expected benefits are maximized in the long run. From the perspective of the shareholder, value maximization expected value or free cash flows are a far more important measure of a firm's performance. The primary objective of a firm from the perspective of all its stakeholders. The stakeholders may be the shareholders, the employees, the customers, suppliers, creditors, local community, the state and others would be defined more broadly as the interests of stakeholders differ and cannot be expressed using a standard measurement. Concept of welfare, consumer welfare. It is defined as a maximization of consumer surplus of the whole economy realized through direct and explicit economic benefits received by the consumers. The consumer welfare model is built on the prevention of abuse of dominance in competition. It is relevant in socio-political and legal implications. Consumer welfare standard is the basis of different policy decisions in competition law enforcement, especially in the merger and acquisition cases. Social welfare. The welfare of the society is the summation of the utility maximization of all individuals in the society. It is not the greatest happiness of the greatest numbers or the majority rule, but everyone in the society is able to maximize the utility from their consumer behavior, that the market and the state provide to the individuals a quality life for their sustenance. In welfare economics, social welfare is theoretically reached with various approaches, as the complexity of human behavior does not enable to reach a single welfare function due to the differences in value judgments and interpersonal comparisons of utility. Competition policy increases overall economic efficiency, giving the consumers a fair share in the total wealth, but it is rarely its exclusive goal. Three approaches are possible. First, competition policy may ignore consumer interests and focus solely on the society's interests and efficiency. Second, it may recognize the intermediate and short-term interests of consumers as the primary aim of competition policy. Thirdly, competition policy might recognize the consumer welfare as an essential long-term goal where the interests of consumers are subordinated to the economic welfare of the society as a whole. Price discrimination and consumer surplus. Price discrimination occurs when a business or usually a monopolist charges a different price to different groups of consumers for the same good or service for the reasons not associated with cost. Degree of price discrimination depends on price elasticity of demand or precisely the elastic and the inelastic demand. Peak off and peak pricing. Peak and off-peak pricing is common in the telecommunications industry, leisure retailing and in the travel sector. At off-peak times, there is plenty of spare capacity and marginal costs of production are low. At peak times, when demand is high, short-run supply becomes relatively inelastic as the supplier faces capacity constraints. A combination of higher demand and rising costs forces up the profit maximizing price. In the peak market, the firm will produce where MRA is equal to MC and charge price PA, and in the off-peak market, the firm will produce where MRB is equal to MC and charge price PB. Consumers with an inelastic demand will pay a higher price PA than those with an elastic demand who will be charged PB. This is being shown in the diagram shown in the previous slide. Another possibility of price discrimination is a firm's ability to segment the markets to prevent consumer movement or switching. The internet and price discrimination. The rapid expansion of e-commerce using the internet is giving the manufacturers an unprecedented opportunities to experiment with different forms of price discrimination. Consumers on the net often provide the suppliers with a huge amount of information about themselves and their buying habits, and that gives the sellers the scope for discriminatory pricing. For example, the computers of all brands. Now, two-part pricing tariffs. Another pricing policy is to set a two-part tariff for consumers. A fixed fee is charged plus a supplementary variable charge based on units consumed. Example, taxi fares, amusement park charges. Price discrimination can come from varying the fixed charge to different segments of the market and in varying the charges on marginal units consumed. Product line pricing occurs when there are many closely connected complementary products that consumers may be enticed to buy. It is frequently observed that the producer may manufacture many related products. They may choose to charge one low price for the core product as a means of attracting the consumers to the components or accessories that have a much higher markup or profit margin. Examples: manufacturers of cars or cameras. Indeed, discriminatory pricing techniques may take the form of offering the core product a loss leader, that is priced below average cost, to induce consumers to then buy the complementary products once they have been captured. Consequences of price discrimination are the loss of consumer welfare and also the loss to the social welfare and equity. Producer surplus and the use of profit. The price discrimination gives the monopoly profit, and the discriminating monopoly is extracting consumer surplus and turning into supernormal profit. Price discrimination may be used as a predatory pricing also to harm the competition at the supplier's level and increase the firm's market power. Profits made in one market may allow the firms to cross-subsidize loss-making activities or services that have important social benefits. For example, the money made on daytime bus services may allow the transport to support loss-making rural or nighttime services. Without the ability of price discrimination, these services may have to be withdrawn and the jobs might suffer. In many cases, aggressive price discrimination is a means of business survival during the recession. An increase in total output resulting from selling extra units at a lower price might help a monopoly to exploit economies of scale, thereby reducing the long run average cost. Total surplus, as it has already been discussed, is the summation of the consumer surplus and the producer surplus. The consumer surplus is the willingness to pay a price minus the actual price payment. Producer surplus is the actual selling price minus the cost. So, total surplus is the mix of the consumer surplus and the producer surplus. This is shown in the diagram. The deadweight loss. In economics, a deadweight loss. In economics, a deadweight loss, also known as excess burden or allocative efficiency, is a loss of economic efficiency that can occur when equilibrium for a good or service is not Pareto optimal. In other words, either people who would have more marginal benefit than marginal cost are not buying the product, or people who have more marginal cost than marginal benefit are buying the product. So, deadweight loss can be beneficial when there is a negative externality, in which case it can be considered a deadweight gain, as it would help those that the negative externality was hurting. Causes of deadweight loss can include monopoly pricing, in the case of artificial scarcity, externalities, taxes or subsidies, and binding price ceilings or floors. The term deadweight loss may also be referred to as the excess burden of monopoly or taxation. This module is a foundation of the understanding of the producer and consumer behavior in the market and essential for the ordinary business of life. To deliberate on the economic benefits of competition law, it is essential to run through the basic concepts in economics. Thank you.